All right, today we're putting taxes on trial. We're going to break down exactly how a new tax affects the price you pay, and we'll do it by looking at two totally different economic worlds, a busy, competitive market versus a single, powerful monopoly.
So let's start with this big question. When the government slaps a new tax on something, who really ends up paying? You'd think it's simple, right? The price just goes up. But it's really not that easy. The real question is who actually carries the weight of that tax? And as you're about to see, the answer changes completely depending on who's in charge of the market.
So here's how we're going to tackle this. First, we'll grab the key tools economists use. Then, we'll dive into our first case study, the competitive market, followed by the monopoly. After that, we'll put the results head-to-head and, most importantly, talk about why any of this matters to you.
Okay, before we start crunching numbers, we have to understand the playing field. Let's get our heads around the core ideas that let us analyze these tax situations in the first place.
First up, in a market with lots of buyers and sellers, all competing, everything is about finding what's called equilibrium. Just think of it like the market's natural happy place. It's the one price where the amount people want to buy is exactly the amount companies want to sell.
But a monopoly? They play a whole different game. They're not trying to find a happy place for everyone. They're trying to find the happiest place for their own bank account. And they have a golden rule for this. Keep making stuff as long as the money from one more sale, that's your marginal revenue, is more than what it costs to make it, the marginal cost. They stop right where those two numbers meet.
And this is where it gets interesting. As the economist Greg Mankiw says, a tax basically drives a wedge between the price you pay and the price the seller gets. Our job is to figure out just how big that wedge is and, who ends up getting stuck with it.
All right, let's put this into practice. For our first case, we're jumping into a classic competitive market. We've got lots of buyers, lots of sellers, and everyone's just responding to the price.
So these two equations you see here, that's basically the market's DNA. The demand equation tells us how much people will buy at any given price, and the supply one tells us how much companies are willing to sell.
So to find that equilibrium we talked about before any taxes, we just set demand equal to supply. We're basically asking, at what price does everyone agree? A little bit of algebra, and boom, it happens at a price of exactly 6 rupees. And at that price, 2,000 units are sold. That's our starting point.
Okay, now here comes the twist. The government introduces an 18% sales tax. This means that for whatever price you pay, the seller only gets to keep 82% of it. And that completely changes how they think about supplying the product.
So we do the same exact thing again, but this time with our new tax-adjusted supply equation. We're finding the new normal for the market. And look what happens. When we solve for the price, it's a bit higher, about 6 rupees and 52 paise. And of course, when prices go up, people buy less, so the quantity sold drops to about 1,740.
Okay, so that was the competitive market. But what happens when there's only one sheriff in town? A monopoly. The rules of the game just get thrown out the window.
Now, for our monopolists, these are the new conditions. They have a demand curve that tells them what price they can set to sell a certain amount and a cost function that tells them what it'll cost to make it. They are in complete control. So how does a monopolist figure out what to do? They go back to their golden rule. Find the point where the extra cash from one more sale equals the extra cost of making it. The math here shows us their perfect game plan. Make about 12 units and sell them for 105 rupees each. That's how they'll make the most profit.
And here comes the tax man again. But this time, it's a different kind of tax. It's a flat 10 rupees for every single item the monopolist sells. This hits their bottom line directly. It's a straight-up increase in their production cost.
Now this is the crucial part. That 10 rupee tax just gets added right on top of their marginal cost, bumping it from 10 to 20. So, with this higher cost, the monopolist reruns the numbers to find their new profit-maximizing point. And what's the result? The price for consumers jumps up to 110 rupees. All right, all the math is done. Now for the moment of truth. Let's put these two markets side by side and see what really happened. Who actually paid the price for these taxes? And here it is. This is where it all clicks. In the competitive market, the price barely budged, only going up by about 52 paise. The sellers had to eat most of that tax. But the monopolist? Wow, they just passed on a full 5 rupees of that 10 rupee tax straight to the customer. That is a perfect 50% pass-through.
This chart just makes it crystal clear, doesn't it? That 10 rupee tax on the monopoly was split right down the middle.
You, the consumer, paid 5 rupees more, and the company's profit took a 5 rupee hit. And that 50-50 split? It's no accident. It's a direct result of the kind of demand curve in this example, and it just goes to show how much power a monopoly has to decide who pays.
So you might be thinking, okay, that's some interesting math, but this isn't just an abstract classroom exercise. This idea, called tax incidence, has enormous real-world consequences for governments, for companies, and, yeah, for your wallet.
Seriously, this isn't just theory. When a government thinks about a new tax on, say, sugary drinks or gasoline, they are running these exact kinds of models. They have to know, is the company going to swallow the cost, or are we all going to see prices spike at the checkout? The answer to that question can make or break a new policy. Which leaves us with this final thought, a really tough question for anyone making policy. If you need to raise money, but you want to protect everyday people from getting hit with higher prices, where do you put the tax? On a crowded, competitive market, or on the lone monopoly? Because as we've seen today, it's not about who physically pays the government. It's about who really has the power to pass the buck.